Jeff, you were on the stage. You presented 3 ideas. I'd really like to focus on 2 of them, starting off with Salesforce, which obviously is a $150+ billion market cap company, adding a lot today as a result and part of your presentation. You say Salesforce has not generated meaningful operating leverage relative to peers in recent years. How should the investing public take that kind of a statement from you?
Right. So, David, great to be with you again. Happy we do this once a year. Look, first, Salesforce is a great company, really like a terrific company, a company that I've admired, that we at Starboard have admired for years. What they've done is incredible. What Mark Benioff has built is truly incredible. When I'm inside companies, when I'm working with companies as a board member or talking with companies, inevitably they have Salesforce, they're using Salesforce, they're becoming a Salesforce partner. So Salesforce is ingrained in the fabric of so many companies and has become so important in the way that they operate and conduct business. So being able to invest in Salesforce for us is terrific. It's a great opportunity. We never expected to be able to have that opportunity. But given what's happened with market conditions, given what's happened with valuations in particular with Salesforce, it's given us an opportunity to be able to make this investment, and we're thrilled to be an investor in Salesforce.
Okay.
As it relates to margins, yes. What we're really talking about is a migration for them, and we've had a great conversations with them. It's a migration for them. As companies are growing really fast, especially in the recent past, they've been rewarded for all of that growth. And then as they mature and as they get larger, they need to produce more and more cash flow for shareholders. And a great way to look at that for technology companies in particular, but really any company, is to look at the sum of those two, the growth rate and the margin,
right,
and see where you compare to your peers.
Well, you talk about a subpar mix of growth and profitability as a reason why there's been a valuation discount.
Yeah.
So what do you want from them in terms of how they should go about addressing that discount?
Yeah, so in the past, they were growing a little faster, but then as you get bigger and bigger, you can't keep growing as fast, and you have to drop more to the bottom line. And when you add those two things together, you get to a number. And as it turns out, with their peers, the median number is around 50%, adding growth rate and profit margins. They, as a great company, they really should be at that number or higher, and they're not.
Why not?
Well, they're not dropping as much to the bottom line. They haven't been as focused on operating margins as we think maybe they should be. And this isn't overly critical. I think they would say the same thing. They're moving in that direction. They're looking to grow their profit margins as well. It's an opportunity for them. I mean, what we would say, what I have said to them, is you're great at all that you do inside your business. You're number 1 or number 2 in all the areas in which you compete. You're highly competitive internally. You want to win. We as shareholders, we want you to bring that same energy, that same focus on being number 1 or number 2, ideally number 1, on these metrics also. And on this metric in particular, they're not even average. So they need to get above average. So what does that mean? It means dropping more to the bottom line.
Shepard Smith here. Thanks for watching CNBC on YouTube.